Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host for the next 60 plus minutes as we go around the globe to discuss the issues related to retirement markets, technology, personal finance, and so much more. And boy, do we have an amazing show this week because Congress passed the Secure Act. The president signed it into law. Lots to talk about it. We're going to dig into it with that and a lot more with our contributors. So sit back, relax, and enjoy this episode of BRN Sunday. We're going to start off this week's show a little bit differently than normal. This is a big week, as we've talked about on the television network, the passage of the Secure Act. And joining me on the line, they are the Legal Eagles, or as I refer to them as retirement rock stars, David Levine, Kevin Walsh, both principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, how are you today?
We're good, Jeff. Thanks for having us on, and happy holidays.
I feel very secure.
No, and that's what I wanted to talk to you guys about. Happy holidays to both of you. So, where are we? This is a momentous occasion.
Sure. Where are we as of today? Well, we have a bill that is passed, the House and Senate, and signed by the president into law. That I know. I
That's
hear
my
the
golf
celebration.
Club. That's my golf
in the
club.
background. You know,
Mazel tov.
Mazel tov. It's like the marvelous Mrs. Maisel. Hallelujah. But it has been passed into law. Now the big question is, what does it mean and where does it go from here?
Yeah.
What we thought we'd do today is Kevin's going to talk about some key themes, and then I thought I might go weedy a little bit and talk about some sort of takeaways for plan sponsors and service providers. And we know your show today must be all about secure. And the one note we're going to add, this is not just secure. This omnibus funding package has a little bit outside of secure, so we're going to weave that into as we talk. Okay. Welcome for our special surprise for today. Mr. Walsh?
I think I'm going to rely on David to do the weaving here. But when I think about the Secure Act...
Wait, you can bob and I can weave?
I'll bob, you weave. I'll duck, and you try to cover.
Okay, we're going to play. Is this man-on-man or zone today, Kevin?
So I think the key here is that we've been talking about the Secure Act now for a year, and before that we talked about RISA for a solid 2 years.
And what are we going to do now, Kevin?
Well, I think we're going to pivot to the next generation of retirement legislation or build MEPs for that matter.
Fair enough. Go ahead.
But to me, with the Secure Act, there's really two big themes. One is coverage, and the other is decumulation. And when I talk about coverage, the idea is that, one thing that Republicans and Democrats agreed on in enacting the Secure is that more Americans need access to retirement plans if they're going to meet their retirement savings needs. And kind of they really go at this in three ways. First is they have this concept of pooled employer plans. And that, if you've been listening, we've been talking about kind of MEPs, the idea that small employers will have it'll be easier for small employers to administer and offer plans if they're able to pay essentially a third party to run the plan. And those third parties running the plan will have more of an incentive to design these things if they're able to have, multiple clients. So if David runs an auto shop and I run a travel agency, instead of having us both run our own plan, we'll be able to hire a third party and essentially have our employees participate in that plan. And this is a pretty big development in addressing the coverage gap for small employers. A second thing it does is it increases kind of the tax credits for small employers who offer retirement plans. And again, the idea is that if more employers offer plans, more employees will be covered. And kind of the third way that this really goes at coverage is with respect to part-time employees. And there's a provision in here that says, if you've got employees who are working 500 to 1,000 hours a year and they meet other criteria,
you're stealing my thunder, Kevin.
That you've got to give them access to your retirement plan. So to me, theme one is that Republicans and Democrats realize that, the first key to getting people to a secure retirement is to give them access to an employer-provided plan. Theme two is decumulation. Decumulation, and that's, we've been focused for a long time on how do we get participant account balance as big as they can? How do we get people to put more into the plan? How do we get people into investment options that are right to kind of increase their balance as they age? But now we've started to kind of focus on how do we make sure that account balance lasts through retirement? And here there's really two ways that they go at it. One is they've bumped up the age for beginning to take distributions from 70.5 to 72. So the idea here is that your decumulation phase, when you're taking money out, if you shorten it by allowing you to start accumulating later, it's more likely that you'll have money through accumulation. And the second is there's kind of a bunch of provisions in here that go at lifetime income products. So one is they're encouraging employers. There's a new disclosure which is designed to get participants to think of their account balance as an income stream versus a pot of money that they can do something with. Another aspect of this is they're making it easier to offer annuities in plan. So there are these products that, if I'm a participant and I'm holding a mutual fund, I've got to figure out when I want to sell my mutual fund in order to meet my needs. If the mutual fund were to go down, I'd bear that risk. So the risk of running out of money is on the participant. If plans start offering annuities, a participant can say, annuity company, I'll give you my money in exchange for an income stream. You pay me until I've passed away. And what that does is it allows participants to put the risk of running out of money on the insurer instead of on themselves. So to me, the two themes here are decumulation, where we're now providing participants with ways to kind of push off some of that risk or push off the beginning of the decumulation phase, and also access. And both of these to me are kind of revolutionary change in the retirement system. And it's nice to see, given that they had kind of bipartisan support.
Okay. So, and Kevin, we joke with each other, but I agree. There's a lot of things in here. I think Jeff, what I'd really like to talk about today is a bit of sort of the practicality. What does this mean for us now?
Please.
Because all of us over the years have seen things pass in Congress, and bluntly, it goes nowhere in real life. Some great examples have been, except for in the governmental plan space, the so-called deemed or sidecar IRAs to attach to your retirement plans. Similarly, we had the combined defined benefit, defined contribution plan for those who are code wonks, code section, I think it's 414X, that never went anywhere. But what does this mean? And so we've got secure. Let's lay out a little more groundwork here. We also, in some relief for minors and their pensions, there's also another change people should be aware of. I just want to flag.
Now, Dave, you're getting pretty wonky here.
Well, you know what, Kevin, you lived in the cloud. So
we're leading the show off this week. We've got to keep the audience's interest.
We discussed this before, and we knew what we were going to do. But the good answer is for those who want to retire early and you want to push people out the door, like Kevin clearly does, in pension plans and some governmental 457B plans, you can allow distribution starting at 59.5. Why is that actually a big deal, Kevin? Because people are looking for early retirement incentives and ways to get people out the door. And it's important to know that wasn't insecure, but that's here. But let's start with a very high level thing, because Kevin clearly doesn't like my in the weeds answer. The key is, if you're a service provider or you're a plan sponsor, when do you need to get all this done? Because remember, secure and reset have been kicking around forever. And if you look at the effective dates in this law, congratulations for all of us lawyers. They go into, a lot of things go into effect January 1st, 2020. Does that mean you need to be rushing and losing sleep right now? The answer is no.
What?
I'm sorry, Kevin. Yes. No, the answer is no. Because in the version of Secure that was passed, they included a so-called remedial amendment period, which basically gives till 2022 or 2024 for governmental plans time to get everything in your house in order. That's number one. Number two, as Kevin, one of the things I think it's really important to keep in mind that a lot of people are going to have to pay attention to as we go forward is the idea for people who are part-time workers. The longer-term part-timers who work between 500 and 1,000 hours. Yes, the transition about when you count gives us some time before we say, have you hit the status for the 3 years necessary to be brought into the plan? You've got time. But this is going to be a big change because you're going to have to start allowing people who work less into your plans. And I work with a lot of people who have, I'll call it on-call employees who never worked 1,000 hours. Now it's 500 hours. For any of you who dealt with the Affordable Care Act and healthcare, it's a big thing to keep in mind. But let me bring it back up a step on two other things quickly and then just call it a day. Because Kevin's themes, despite how much it pains me to say this, are spot on. Number one, let's talk about MEPs a little bit more. Kevin made the joke, oh, well, I'll be building MEPs. You know what? We could be. But there's a lot here because they're just like in the so-called all-union multi-employer plans, there's questions about the role of the trustee to make sure contributions come in. The process of building a MEP, and I've been working on a lot of association retirement plan MEPs and other ideas over the last year. in those discussions, as we try to build those, there's a lot of question of, well, how do you make sure the payrolls align? How do you fit all this together? Who's responsible for getting dollars in the door and accounting for it? There's a lot of good things, but there's a lot of I's to be dotted and T's to be crossed. So it'll be interesting to see where it goes forward. So if you're an employer and you're considering this, or a service provider, one of the things I caution you is to say, what am I outsourcing and what am I not? One of my favorite phrases is 31 flavors of ice cream, and it applies to MEPs. There will be a lot that gets outsourced, but each MEP will outsource, but kick back to you as a sponsor a bunch of responsibility. The key is to understand, what are you keeping and what are you not? And it's all going to be in the contract. So us lawyers are going to have a field day, but it's important to know. The other thing to keep in mind is also that in MEPs, in building them, if you're trying to build one, don't forget, the Department of Labor, the fiduciary rule, we may be getting a new one, and it may be back to the old fiduciary rule prior to everything we went through for those years. The key takeaway on that, though, is you still have rules about when you get paid, how you get consent to get paid, and the Department of Labor is going to have to write some rules. So between guaranteeing contributions, payroll processing, and also prohibited transactions, it's something to think about. The other thing that I think is very important to keep in mind, and this is practical for any of you who've got an IRA, and it applies to every one of us, the required minimum distribution rules, changing them to age 72 starting next year. That's a big deal, but it also means that you can't do stretch IRA and planning. And if you're lucky enough to have enough money that you're planning about which money you draw so your heirs can inherit it, with some exceptions, your beneficiaries are going to have to take their money out within 10 years of your death. You may say, what do I care? I'm dead. Or you might say, and I make that joke because my dad used to tease me with that all the time. He's like, you better be nice to me. I'll be dead tomorrow. But the point is, the key is that it's going to affect a lot of people's planning and education. So with all those wellness and other solutions and people's planning, it's time to revisit. I could spend hours in the weeds, but I'm going to let Mr. Walsh bring us back to the clouds.
So I was just going to bring us back to the clouds by saying that the Secure Act it's a big deal, and there's a whole lot of provisions, and we're not going to have time to get into all of them on this show, and we'll go through some on other shows. But if you're interested in learning more about kind of specific provisions of the Secure Act, if you go to groom.com in the resources page, we've got kind of a write-up that walks through the Secure Act, what it means, and how it impacts participants, employers, and service providers.
That is a lovely plug, Kevin, and I can't think of a better place to look. And thanks for letting us lead off, Jeff.
The write-up is really our holiday gift to the listeners.
Yeah, well, all I can say is, and go ahead, David.
I was just going to say, it also makes great bedtime reading, but for those of you who want to read it elsewhere, good for you.
Yeah, and I would say that I don't think anyone who heard this segment thinks that what you talk about is boring, because I think the comedic aspect of it was great. And in all seriousness, it's amazing job you guys have done over the last couple of years, at least on the podcast, covering this and walking us through it. And we really appreciate you leading off the show this week with what's it all mean, because I can tell you, just having been in the business, I'm confused, but you guys really laid it out really well, and I think you guys have a nice give and take, so appreciate that. So, gentlemen, we'll look forward to hearing more from you later after the holidays. And we'll talk to you again very soon. Enjoy the rest of your week, and Merry Christmas, Happy New Year, and Happy Hanukkah, and all the other things.
Merry Christmas, Kwanzaa, Diwali, Eid to you, our friend. And the other thing we'll say is coming soon, the Retirement Security and Savings Act. Talk to you in 2020.
Bye, guys. Take care.
Bye.
Yeah. Welcome back, and it was a great segment with David and Kevin talking about the Secure Act and the passage of that act. Really important, I think, for Americans around the country to save and plan for their future. And now we're going to shift gears, talk a little social media, and I suspect that Devin Banerjee, Senior Financial Services Editor from LinkedIn, may have his own comments and perspective about Secure, but I'm going to ask him. So, Devin, how are you, my friend?
I'm doing great. How are you, Jeff?
I'm fine, and I didn't want to mean to lead the witness, but I just suppose that, there's a lot of people on social media and a lot of people on LinkedIn who are in the retirement space, and just thought maybe there might be a trend line there. But hey, look, it's your segment. You tell us what's top of mind for you and your team.
No, absolutely. Let's start with the Secure Act. So we did feature all the details of the act actually earlier this year when it was first proposed, and the conversation that followed on the LinkedIn platform was really interesting, really nuanced. So I would say generally people really cheered and applauded most of the changes. Certainly the raising of the age for RMDs, for required minimum distribution, was applauded. The raising of the age for the ability to contribute to a traditional IRA after age 70 and a half was certainly applauded, especially given how much news we feature and conversation we feature around people working longer around the world. One of the more nuanced conversations was around annuities. So obviously one of the elements of the Secure Act is removing some of the, or removing all of the employer liability for annuities placed in plans. So that really paves the way for annuities into retirement plans. And, a lot of, and now I'm generalizing, but a lot of the media stories and reaction has been, oh, this is really hairy and this is really scary. There are a lot of high cost, opaque annuities, but we actually saw an interesting kind of emergence of some of the elderly population on LinkedIn talking about the value of guaranteed income. And it's actually something a lot of them seek out for peace of mind and for just emotional kind of safety and stability. So I think that conversation will probably increase as this act moves through passage and into enactment, likely, which is just a really nuanced conversation around annuities, which I think is actually great, because a lot of the issue with that space has been that people have not spent the time learning about it and educating themselves. So I think we'll see a crop up of players in that space to kind of educate retirees. So I'm looking forward to that.
Yeah, I would agree, and I second your point of view about education. I think, it's just smart to educate yourself on the different investment products, and annuities deserve that level of evaluation and scrutiny as well. And do they, they're not, nothing is a solution for everybody, 100% of everybody, but I think they have their, can be part of a balanced financial plan. And you don't have to annuitize all of your money. You can annuitize a portion of your money and draw down from that and use other portions of your money, leave it in the market or whatever. I mean, those are conversations best had between yourself, your significant other, if you have one, and your financial planner, if you have one. And I think that's one of the more interesting provisions, and I've seen a lot of that as well. I certainly look on I'm often on LinkedIn, and I also saw a lot of the accolades being thrown around for not only the retirement community, but also the bipartisan nature. Apparently the one bipartisan, Devin, idea or concept that both parties can agree on, which is helping people save.
Yeah, absolutely. And one more provision of the bill I'll just mention that we saw a great conversation around was about the ability for multi-employer plans to take shape and take form. We have a lot of SME members on the platform, small business owners and operators and employees, and they really applauded that provision as well. It can be quite expensive to administer those plans for one small employer, and this bill would allow those multi-employer plans banding together. Also, gig economy workers, this does allow some more options for them as well. So I'm looking forward to that as well.
I would say so, and then I think there was another provision in there, if I'm not mistaken. We when you mentioned multi-employer, I wasn't even thinking MEPS. I was thinking some of those central states, the union plans that we've been reading about, the pensions that have been underfunded and may collapse. Yeah. And I believe that often referred to as the coal miners pension bill, and I think that was in the appropriation bill as well. To rescue or support or come up with a game plan to support those significantly underfunded plans, which is important because if that was to be disrupted, that would actually disrupt people's retirements, people who are depending on that income that they're already getting.
Yeah, absolutely. I mean, I haven't looked that deeply at that provision, but I would say, those plans and those people who are relying on traditional defined benefit pension plans that are severely underfunded certainly need help. Absolutely.
Yeah, absolutely. So shifting gears a little bit, what else was kind of piqued your interest? I mean, there's a lot of, obviously there's a year end, there's holidays. I mean, but is there any other trends that you saw, any other stories that were really top of mind for you and the team?
Yeah, absolutely. Really interesting conversation around a growing rising force in the labor market here in the U.S., and that's actually Latinas, Latino women. So the most recent jobs report we were digging into, and some other media outlets were digging into, shows that 61% of Hispanic women are part of the labor force, and actually the national average rate for women is only 59%. So this, as I said, has been a growing force, a rising force. Hispanic women. By the end of this coming next decade, Hispanic women are projected to account for nearly 1/10 of the workforce, actually. And so, in addition to low unemployment, we're seeing drivers like increased education and just shifting cultural norms, especially in the Hispanic community, where women are going to work, in many cases, are seeking financial independence, and that's really pulling in these women. And so it's just one of those things for, obviously, big picture policymakers to think about, but we're also really seeing in the conversation on the platform that communities are being transformed. Small businesses are finding this new emerging force in the labor market when they're looking to hire. And so I think that's a really interesting trend, and I'm excited to see where it goes next decade too.
Yeah, and I mean, it's nice to see different groups get represented and have the opportunity, and that's what it's supposed to be about. Really interesting data, and I mean, obviously, you guys have access to a lot of the information. You see all the posts, I would imagine, and you're able to. You and the team are able to look at all these different data points and all this different research that's coming out from various groups. It must be really fascinating, just as taking a personal moment.
It is. I personally learned so much. And there was one story we featured. It was actually a series of recent research studies this week that I really loved, because I've kind of changed my lifestyle recently to try to get a lot more sleep. And this was a series of studies that shows that, especially among founders and entrepreneurs, people like you, as a matter of fact, Jeff, we hear a lot of them, although you don't do this specifically, but we hear a lot of them, especially here in Silicon Valley, where I'm sitting, kind of extolling the virtues of sleepless nights and hustling and all of that. But in these three studies, researchers found that sleep-deprived entrepreneurs performed far worse when they were asked to evaluate strategy and business ideas. They ignored, really important structural issues. They ignored historical context. They kind of just mentally reached for the easiest accessible things to their mind. And the researchers say, the results suggest, obviously, getting a good night's sleep before making big decisions that can affect, your business's strategy or direction, which, as you know, Jeff, as a founder and entrepreneur, is basically almost every decision you make is pretty fundamental to the future of your enterprise. So I found this to be really interesting, and I want to ask you, Jeff, I hope you prioritize sleep. I try
to, and it's interesting that you bring that up, because I was listening to a podcast the other day, and they had commercials, and one of them was from Dr. Sanjay Gupta, I think his name is, from CNN, and he was saying that there was a study that children or people in school, they don't have to necessarily be children, but they could be young adults, that they do far better when they study, number one, and number two, that they get sleep before a big exam. So that leading up to exam, they're not cramming. I guess it makes the point that cramming doesn't work. So I'm a big believer in sleep. I think I personally have trouble sleeping. My brain's going 1,000 miles a minute, but I do try to get sleep, and I have been known to catnap during the day with my two cats, Peaches and Sebastian, much to my wife's chagrin. But I think it's important, and I totally agree with that. I mean, if I make a bad decision as the owner of a business, if I say something incorrectly or I don't, that could cost me significantly in a lot of ways. Reputation, and also potential advertisers or even contributors. I mean, who wants to be around a loser who can't figure out what they're saying, right? I mean, that there's a lot of ramifications. But yeah, I think you're right, Devin. And I'm happy that I'm glad that you found this earlier than I did. That sleeping is important. But
yeah, and speaking of students, actually here in California, the governor signed into law just a couple months ago a new start time for public high schools and middle schools here in California. So high schools starting at 8:30 at the earliest, and middle schools starting at 8 a.m. at the earliest. And when I was in high school, public high school in California, I had a zero period, I remember, that started at 6:40 a.m.
Oh, my Lord.
And yeah, it was just wild. And I guess I found it fine, but now I think about my parents who, are working professionals and have to drive me in the morning. And, now as I think about if I had a kid with a 6:40 start time, I don't know if I would wake up for that.
Yeah, I think it's tough. A lot of kids these days are night owls because they're probably doing schoolwork and doing their schoolwork, but also gaming is apparently really big. And we only had the Nintendo NES and the Atari 2600 when I was a kid, so I'm really dating myself. But Devin, always a pleasure talking with you, and I know we're going to see each other on the network on Monday, and then we kind of go into our little holiday mode, but look forward to chatting with you more about Secure and some other really important topics for the audience to know. Thanks so much for joining us, spending time with us, and we will talk with you soon.
Sounds good. Take care, Jeff.
Bye. Yeah. Well, we're going to shift gears now and talk to Senior Technology and Consumer Products Reporter Daniel Klein. Hi, Dan. How are you?
Hey, Jeff. How are you?
I'm doing fine. I should have said your affiliation. You are with the Motley Fool and a lot of experience writing with various periodicals, but always great talking with you. Great having you on the network and having you on the podcast. So before we jump into technology, Dan, I want you to weigh in. It's Secure and more on this program this week. Why don't you weigh in? What are your thoughts about the passage of the Secure Act, signing of the bill into law?
Yeah, so I think what we're not talking about is how impressively bipartisan this is.
Mm-hmm.
We're kind of at a day and age where if one party says it's raining, the other party will say it's sunny just to argue. So I do give Congress credit for passing something which largely improves retirement, or at least the possibility of doing that for a lot of Americans. I think the benefits of this in extending retirement benefits to more people and making it easier for small companies to offer 401ks and retirement plans, I think that's great.
Yeah.
The one word of caution on this is an annuity on paper sounds great. And part of the Secure Act is the ability to purchase, sort of use your 401k to purchase an annuity. And an annuity sounds great. You pay money in and you get a pension-like sum for the rest of your life. That's great, except historically, and I don't want to disparage any one company, but historically the companies that offer annuities have been a little bit questionable. So it's a product that there's nothing inherently wrong with, but before you buy one, you want to do your homework to a tremendous level and make sure that you're going to put money into something for, be it 20, 30, even 40 years, that when you actually retire, that money is going to be there, and there's no caveats, there's no companies going out of business, there's no, we had a change in ownership, so now we only pay you this much. You want to really, really know what you're getting.
Yeah, and so let's go back to your first comment about bipartisan. I think that retirement and talking to people on the Hill, people around the industry, this is really one of the last bastions of bipartisanship. Everyone agrees that we need more retirement coverage, and so that's why this is really a landmark bill, and it got through in this appropriations bill that was to fund the government. So I agree with you on that. And then secondly, and I also applaud and agree with what you're saying in terms of vetting any financial product, whether it's annuity, whether it is a mutual fund, whether it's an ETF. You should understand all the tenets associated with that particular product. And so what Dan's referring to is the Secure Act allows for greater annuitization within a retirement plan like a 401k, 403b, 457b governmental plan. And agree with you. I mean, you can't just rely on what people tell you. meaning an advisor, a friend, a broker, whatever, you've got to understand as a purchaser, a consumer, right, Dan? We talk about this all the time when it comes to Netflix, when it talks to streaming. You've got to understand the basics about this stuff.
Absolutely. And there's also so this increases access, but it doesn't force you into it. So there's that old maxim about the person praying to God, why can't I win the lottery? And God finally speaks back and say, geez, could you meet me halfway and buy a ticket? So this is a case where the government can give you access to retirement plans. And when you're 25, taking, let's say, 5% of your income in order to get an employee match of 2%, that 5% seems more valuable in your pocket now than it does at some vague retirement date where we'll probably all be wearing spacesuits and eating our meals in pill form. The reality is, the sooner you start saving, due to the magic of compound interest and the fact that the stock market returns on average about 9 to 10% each year, if you look at long-term historical averages. So if you put a fairly minimal amount of money away when you're 20, that cuts it for you what you have to save at 30, at 40, at 50. It makes retirement possible. I'm not one of those people that says, like, you must have $2 million to retire, because the reality is, you must have a different amount. If you're going to live in Central Florida, that's a lot cheaper than living in New York City. We've talked about that before. But if you're younger, whatever age you are, now is the right time to start saving if you haven't already. So if you're 50, you don't want to take the attitude of, well, I can't save. At least save something so you have some hedge against maybe someday you can't work. Maybe you won't fully retire. You'll work part-time. So the government can make it possible, but you have to do it.
Yeah, all true statements, and I appreciate you weighing in on that. And before we jump into technology, because I want to give you a chance to talk about tech, I want to ask you two questions. First, did you see the new Star Wars movie? Because we're now a couple days. Oh, go ahead.
So by the time this airs, I will have seen it. But when we're taping this, no, I haven't.
Okay. And then secondly, have you seen the latest Mandalorian episode? Dan?
Yes, I watched the latest Mandalorian episode because they released it for some level of tease for the new movie, and I did not see anything in there that did that.
Okay, well, I think you're going to enjoy what you saw. So let's appreciate your comments on this Cure Act. Really important points of view. We want to get all different points of view, from attorneys to journalists to technologists like yourself. So let's shift gears and let's talk a little technology, because I know there's some things that you want to cover beyond the Secure Act.
Yeah, so let's talk about the story I sent you about a smart toilet. So we're in an amazing era of fitness technology. We've talked about the Apple Watch. I'm wearing a Fitbit as we tape this that tells me my heart rate is at 78 at the moment, so I'm not all that excited as we tape this.
That's good.
And Apple has the ability to, on an aggregate level, do heart studies and diabetes research and all sorts of research just from what it gathers from the Apple Watch. And you're starting to see companies like Best Buy sell products for older folks that build on the old, life alert, I've fallen and I can't get up model, that actually tell you when things are going to happen, or can, alert you that you're having a heart attack and then call the doctor and an ambulance and all those other things. And the next step of this might be a toilet that can look at your urine, using sensors, and say, hey, geesh, there's too much sugar in here, or you might have this wrong. There's a lot of things you can tell simply by monitoring, to put it bluntly, your output. And that might be the next step. Like, it might be as simple as telling you, hey, you're dehydrated, go have some water. Or, there is a marker for something being wrong here. So we're moving into an era where health isn't becoming something where you either go to the doctor when you don't feel well, or you go to a once-a-year physical and they do a check and they tell you if something is wrong. The earlier you discover something, generally the better it is. So if your toilet can tell you, oh my God, like your white blood cell count is low, and I don't know if the toilet can do that, you might go to the doctor and find a cancer but you might find it 6 months before you have a symptom, and that should make treating it easier. So it sounds ridiculous, and we're certainly a long way away from this being common, but this type of technology is going to be part of the future, and it's going to help us live longer.
You know, Dana, we covered healthcare this week, and I know both you and Devin Banerjee spoke about healthcare trends. Devin covered bills and costs, and you talked about technology. And I'm just putting in my mind the image of we had talked about smart toilets on the television network, what the B-roll would have been to look, what some of the footage would. But in all seriousness, I mean, obviously, wearables, Fitbit, technology. Heart rate monitors, those things. You can even do like EKG, some types of EKGs on your phones and on your devices. I mean, this seems like the future, and I don't see why the technology wouldn't exist to test urine. You give a urine sample at the doctor's office. Why couldn't now I don't know how much the toilet would cost to do this, but why couldn't the toilet take a sample of your urine and analyze it, right? I mean, it makes sense to me.
The technology is there. It's just a question of whether enough people want it. Probably the first instances will be diabetics and other people who have reason to monitor some of these things. And so I'm headed off to CES in a couple of weeks. And at CES for the past few years, I haven't gone every year, but I've covered the show remotely even when I haven't been there. You will see technology that may or may not seem like a good idea. The one I always talk about is there are refrigerators that will tell you when your eggs and your milk have gone bad. And they show those every year, but nobody buys them because the reality is we don't need a refrigerator to tell us when eggs have gone bad. Generally, you buy eggs once a week, and if you haven't used them, you get rid of them because that's the lifespan of eggs. And milk, when you go to pour it, will tell you if it's bad. You don't need you don't need the refrigerator to do that. So it's possible the smart toilet will be that it'll just be something that either is too expensive or maybe there'll be a much easier method of doing those same tests through your watch or through some other system. But the underlying idea that we're going to more proactively monitor our health is something that I think will be a theme at CES, and I think it's going to be one of the big stories for the next few years because it's clearly very important to Apple. It's very important to Best Buy. It's something Google's thinking about with Fitbit. So, if you don't have to go to the doctor and learn, oh, hey, your blood pressure spiking, you should look at that. That's information that might save your life.
And also could save money, right, Dan? Because you're not using health services unnecessarily. You're going when you need to go, and you can do it. Oh, go ahead. I'm sorry.
In theory, it could tie in with telemedicine, which is something we've talked about. So it might be a situation where you're using, your watch to monitor your heart rate, and you then jump on with a doctor and you show the doctor, hey, here's the pattern. Every time I eat a spicy pepper, my heart rate spikes to 110. Is that normal? That actually is normal, and it's nothing to really worry about. But geesh, when I walk up a flight of stairs, my heart rate goes to 150. Well, that's not so great. And there might be proactive steps you can take to deal with that. So there's going to be a lot of ways to democratize healthcare, to make it a lot easier. I mean, we're seeing, services now where you can get some basic medicines, generally for things that are embarrassing to talk to your doctor about, but you can get those by talking to a doctor online and getting prescriptions. You can go to Teladoc to get antibiotics if you have certain things. You can walk into a CVS Minute Clinic or the CVSs that have health concierges and get answers about a lot of things without having to go to a doctor. So I think you're going to see healthcare be available to more people because I'm wearing an $80 Fitbit. That's not a particularly hard barrier for most people to reach.
Yeah, and I just went to I had my annual physical today as we're recording this. Everything's okay. No one needs to worry. And Mom, I'm doing fine. But they had a Bluetooth EKG device, and that was really cool. So they just hooked me up to the probes, and then the machine was in like the other room, and it was connected by Bluetooth, which is amazing. So I think that we're going to see revolutionary ways that we can read people's information, get people the data they need, get doctors the data they need. But Dan, going back to our conversation about the Secure Act, And your responsibility as a person, you've got to take the steps to monitor your health and do the right things. You can't just rely on a device.
No, it's important. So, I mean, we've talked about before that I am 8 months into a pretty massive health kick. I am working out with a trainer 3 times a week. I work out on my own once or twice in addition to that. I monitor my heart rate and my steps every day. I'm being a little bit more careful about what I eat. And I'm trying to add in better choices sort of as I hit different milestones. So one of my goals in the new year is to find something that's cardio that's fun. So maybe I'll play some tennis or some volleyball or who knows what it will be. But I'm taking a very proactive approach to it because I realized sort of by, my pants not fitting well, that I had been taking I walk a lot. I get about 10,000 steps in a regular day. That wasn't doing it, and I needed to do different things. There's a principle in exercise where if you just do the same thing over and over again, your body gets used to it. So it's important to shake up your routine, to do different things. Every time I see the trainer, it's a little different. Or sometimes we'll just totally, use body weight instead of weights, or we'll do a lot of different core exercises. Just, it's about shocking your system and being very proactive, and also understanding that what worked for you at 25 might not work for you at 46. I used to be able to be somewhat out of shape in the winter because I'm asthmatic, and when I lived in the north, I couldn't do as much in the winter. And then the weather would get good, and I'd go jog on a treadmill for 2 months, and I'd be in like tip-top shape again. Well, now it's 8 months in, and I'm in notably better shape, but it's a multi-year process to get where you want to go. And, when I tried to run a year ago, I messed my knee up and it cost me a lot of time at physical therapy. So it's just like retirement. You have to adjust as you go. You have to talk to professionals. You have to research. You have to be a little bit skeptical.
Yeah. Well, Dan, always a pleasure talking with you. And we covered the gamut. We did inflows and outflows. I love how you position that. Spoken like a true technology guru. So we will. We're not going to see you this Tuesday because it's Christmas Eve, and we're going to have a best of. But we will see you possibly the following week. So enjoy your holidays. Get some rest. Get some time off, and enjoy CES when you go there.
Merry Christmas, Happy Hanukkah, Joyous Kwanzaa, Happy New Year. May the Force be with you.
Thank you, Dan. Enjoy the movie.
Thank you.
Bye-bye. Welcome back. Now we're going to shift gears, talk a little markets. And joining me on the line, he is the co-founder of Delphi Digital, a cryptocurrency research firm, Kevin Kelly. Hi, Kevin. How are you?
Doing great, Jeff. How about yourself?
I'm doing well. You have a good, you all ready for the holiday?
I am. Still have some last minute Christmas shopping to do, but I assume I'm not alone in that regard. I think a lot of people are kind of on the same boat. But yeah, gearing up for the holidays, excited for a little bit of time off.
Yeah, good for you. Good for you. Well, a lot going on. It looks like the markets, and I want to get your take on the markets, but also talk a little crypto since we have you kind of one-on-one. But let's talk markets. I mean, I was just looking at the Dow Jones Industrial Average in between the segment break. And at the beginning of the year, it was close to like 23,000, and now we're up close to 29,000. And kind of looking back, what can you tell us, just broad theme-wise, in terms of looking at the market this year, but also recently? I mean, we've got all these political events, the trade agreement or not agreement with China. A lot of things going on this year that produce a lot of volatility.
Yeah, no, for sure. I mean, looking at the kind of broader trends that really drove the market this year, I mean, probably the most obvious that you could point to was the Powell pivot and the kind of pivot and just broader major central bank policy that we've been talking about all year. Because if you do rewind the clock to this time, right around this time last year, I mean, the market environment, the macro backdrop was drastically different. We were kind of, at this point, the Fed was, within days of right now, was on their way to kind of their ninth hike that cycle in 3 years. Monetary policy was getting a lot tighter, not only here in the U.S., but globally. You had the ECB, who had officially announced that they were confirming that they were stopping their asset purchase program. You even had some talks out of, the Bank of Japan, which has been one of the, I guess you'd say not necessarily most influential, but one of the most active central banks in terms of market intervention this cycle, and really for the last, couple decades, because that economy's really lagged. You even had the BOJ coming out with some more kind of hawkish commentary. And so as the market got really spooked this time last year and right in that Christmas Eve, right around Christmas Eve, when you had the market kind of bottom out, you did have, a lot of major central banks, including Jerome Powell, the Fed chair come out and say, maybe we did hike a little bit too quickly, and pretty much kind of pivoted away from this, tighter indefinite policy towards a more looser and accommodative one. And so that kind of led to, a little bit of a resurgence in market confidence. Maybe the Fed would, kind of ease financial conditions a bit. And then you saw the market really kind of not necessarily, take a V-shaped bottom, but really kind of bounce back, and then was pretty much off to the races for most of the year. As you saw, more kind of central banks globally coming around to this easing instead of tightening policy decisions.
Yeah, I mean, it's just you mentioned the bottoming and then popping back up. That V-shaped, almost the V-shaped recovery during the year was really unbelievable. And now here we are. I think we had broken 29,000, and we're close to ending the year at 29,000 in terms of the Dow Jones Industrial Average. I mean, people who own 401ks and IRAs and other accounts have to be very pleased. And remember when we spoke at the beginning of last year, people were like saying they were boasting at their 401k balances online, and then boom, we hit the bottom, and now is this a repeat? I mean, what's your sense? I don't want to put you on the spot. What's your sense when you and the team, and then we'll get into crypto, but when you look at the market going forward in 2020, I mean, is it more the same? Do we have more volatility? Is it just we don't know anything?
Yes. Yeah, no, it's a really, really good question. And again, to take a step back, you mentioned the Dow. I mean, if you look at the S&P 500, it's up 30% this year if you include dividends, which are a small, very small part of those large kind of gains that we've seen this year. So for starters, definitely don't, see the S&P rising quite as much next year, because I do think there's a lot of headwinds as we get later into this cycle that the market still hasn't gotten answers on. I think a lot of the recent recovery within the stock market has certainly been around a bit of the trade uncertainty, alleviation of the trade uncertainty, as well as kind of a bottoming out of this global economic slowdown that everyone was calling for. You've actually seen the data really kind of turn around, and so again, people are starting to come around to realize that it's not really, the economy's not really as bad as a lot of people made it out to be. And what's interesting is that this year has been kind of defined by that everything rally, right? Where not only stocks have risen, but at one point earlier this year, you had gold as well as long dated treasuries, U.S. Treasury bonds that were up 20+% as well. So is this really everything rally? Again, a large part of that goes back to the change or the shift back to more accommodative monetary policy, or at least the commentary around it. And so what I certainly foresee, I think the market can stay, relatively elevated, at least heading into next year, unless you get some really kind of reversal in the recent trade progress or some other, headwind that pops up. In terms of volatility, I mean, you still have the Federal Reserve expanding its balance sheet to try and alleviate some of the pressure on the repo market. And so historically, when you've seen, the Fed's balance sheet expand, that's actually usually dampened volatility, right? So you could see, at least in, let's say, the first quarter of next year, the market relatively around these levels. I don't think, we're due for anything really, really too crazy. But on the flip side, what I am starting to see is, you mentioned last year when you had people bragging about 401ks and things like that and their returns, you are starting to see a sense of that euphoria come back in the market right now, because if you look at just different kind of retail sentiment indicators, a lot of people were still pretty bearish, throughout this year. And then you've really kind of seen that flip over to a lot of the bulls coming back out and saying stocks are headed higher right as you're hitting, 3,200 in the S&P 500 for the first time, so an all-time high. And the bears have kind of, crept back into hibernation, I guess you'd say. So we are starting to see a bit of that euphoria come to fruition. It's not necessarily a melt-up situation, which is usually when stocks rise just based on, almost irrational exuberance. We haven't necessarily seen that yet, so we might be in for kind of a blow-off top from here. But I definitely think that is one of kind of the key concerns, and you're starting to see people actually increase some of their hedging positions for stocks specifically because of the gains that we've seen this year, and people saying, okay, maybe next year's most likely, all odds probably not going to be similar to this year. Maybe you have the S&P up, single digits in terms of percentage points, but certainly don't expect it to go up another 25 to 30%. So you are starting to see people actually take out protection on the downside, which again, coupled with that, rise in sentiment and some of that close to irrational exuberance, I think that's going to be kind of a big risk as we head into to the new year.
Kevin, I want you to put on your crypto hat because when last we talked, I think Bitcoin, cryptocurrency had taken a little bit of a tumble. But it's been kind of up and down. It's a market like any other market, and as we round out the year, I mean, we've got one more show to do next year, but I mean this year. But what's your take on the crypto market? What from a research perspective, for someone who's been in the space for quite a while now?
Yeah, it's been just to put the whole year in perspective, like we did with the equity markets. I mean, people often forget and this is just recency bias that creeps in because again, the crypto market and really even Bitcoin is down, almost 50%. Some alternative crypto assets are down even more than that just since June, right? So that the second half of 2019 was almost kind of a polar opposite to what you saw in the first half of 2019. And a lot of that was driven by some of the, at least in my opinion, some of the similar factors like we talked about with the slowing economic growth narrative, the idea that central banks were going to basically turn on the printing press, which obviously gives something like Bitcoin a hard, scarce asset. Really gave it a bid within the market through really Q2 into this summer. But if you look at taking a step back and looking at the entire year, I mean, Bitcoin's still up 90%. It's almost doubled since the start of 2019, right? So when you talk about even stocks being up 30%, I mean, Bitcoin's tripled that this year, even though it's had a pretty significant pullback recently. So it really kind of goes back to, depending on who you are and what your time horizon is, it's very difficult to time, traditional markets in general, especially even markets that are very kind of niche and inefficient, like the crypto market. And I think what, we're waiting for now, and part of this plays into what I was talking about in terms of the irrational exuberance within, the risk assets, the equity markets. If you really do start to see kind of a flip of the switch where things do roll over, most likely the catalyst being something around trade, and you start to see risk assets pull back a bit, depending on what the cause is and what the reactions are from major central banks. If they come back and they start to reverse their recent commentary, more hawkish commentary, and come out and say we're going to be more accommodative, that certainly could give another bid again to Bitcoin in the crypto market. So right now it's kind of you're in a bit of limbo, and it's more of a trader's market because you haven't really seen a lot of new demand come in, at least in the last couple months. It seems like it's a lot of the same people or funds kind of trading money around the crypto space. And so what everyone's kind of waiting for or trying to find is kind of that next big catalyst, like that narrative, that digital gold narrative that really drove Bitcoin earlier this year, trying to find what that next catalyst is going to be to kind of break out of this, this downtrend.
Do you think that, most large pool investors are bullish and long term, but do you see any of this volatility, things that we've seen this year with crypto being a dampener on interest, or do you continue to see interest from those asset pools?
Yeah, no, I mean, it certainly is. The volatility aspect, it's a double-edged sword because in order for, the people who are long-term bullish on Bitcoin, obviously, us being a research consulting firm focused on this space, we truly do believe in the long-term potential of it. And in order for it to have outsized, outperformance long-term, you have to basically expect the downside volatility to come with the upside volatility, right? You can't really have one without the other, unless you're talking about markets that are that have a lot of, external intervention and are almost manipulated. I mean, if it's a free market, you're going to expect to see a lot of volatility on both sides, right? So longer term, I mean, yes, we see the space maturing, and with that, you'll see trading volumes increase, liquidity, the market becoming bigger, and then you'll get some of these larger kind of institutions into the space. But on the days in which, or the couple days in which you see Bitcoin fall, let's call it 10, 15, even 20% at times, that certainly has, I think, given pause to some of the institutions that want to get into the space because, again, just trying to think about how you manage that risk compared to, because it is an asset that's liquid and volatile much more than even like your equities or some of your emerging market risk assets. So it's a little bit tough for institutions to kind of put their finger on exactly how to integrate this into an optimal portfolio strategy.
Yeah, I think more to come on that. I mean, it's like any market; it just takes time to kind of flesh itself out, and the more people
Absolutely.
understand it, the better. And that takes time. You just don't understand a market. I mean, it's a relatively new market, and I know your firm has several years old, but I mean, you just have to understand, you have to have a track record. And so
Yep.
institutional investors want a track record. They need that track. Usually it's 5 years, right? I mean, they've got to have
Right.
that 5-year market track record in order to invest and decide to include and purchase into an asset. But I would suspect that over time things start to be less volatile as the market becomes more efficient and as there's more of a track record.
Yep. No, absolutely. You hit the nail on the head. I mean, if you think about, really quickly how short the history is of even just Bitcoin, right, which is a little over 10 years old, there's only a handful of funds that really were in this space, back in, end of 2014, right? So to your point, even though institutions and what we're seeing on our end, especially with some of our consulting services, their institutional demand for education is still high. It's waned a bit, kind of with prices, and it's a bit cyclical, but still huge demand for understanding this space. And so I think that's kind of the inflection point we're at now, where yes, institutions want to get in, but they're actually mandated, or their mandates kind of prevent them from getting in. And so the next kind of catalyst really kind of has to push the market higher in order for some of that interest or enthusiasm to come back, I think.
Yeah, well, I guess more to come in 2020, although we've got one more week to go. And Kevin, we always appreciate you in joining us and giving us your perspective, and actually wearing two hats, that of the equity strategist and also that of the co-founder of a cryptocurrency research firm. So more to come there, but wishing you and your family a very happy holidays and a happy new year, and we will talk to you very soon.
But my pleasure, Jeff. You as well.
Thanks, buddy. Bye-bye.
Yeah.
Welcome back, everyone. Now we're going to shift gears, talk a little about personal finance, perhaps, and real estate with MarketWatch's real estate reporter, Jacob Passy. Hi, Jacob. How are you?
I'm doing well. Yourself?
I'm doing well. Coming down the home stretch for the year. It's holidays, trying to compress a lot into shorter period of time. So, but doing great. I'm so happy happy to be speaking with you. So, what's top of mind with you and the MarketWatch team this week as far as real estate?
So this week I put out a story that is kind of functioning as our, forecast for the housing market for 2020. So, discussing with my editors, all these different, organizations, companies put out their, own housing forecasts, Fannie Mae, Freddie Mac, et cetera. And, rather than doing, one story on each of them, we decided to kind of do a roundup and, take a look at, what everyone is saying kind of in the aggregate. And also, my story also just kind of looked into, the predictions people made this time last year for 2019 and how those came to fruition or not. Because it's kind of important, I feel like we always see these forecasts, and it's important to kind of put them in context because, the economists themselves will readily admit that they are not psychics. And they're taking a certain risk when they put out a forecast that it will be wrong, and 9 times out of 10 it is to some extent. So first off, what happened this year and how did it align with what people were guessing last year? And it's kind of an interesting story. So people probably will remember this time last year mortgage rates were closer to 5%, much higher than they are now. Now they're below 4%. But this time last year, forecasters, seeing these higher interest rates, expected the interest rates to go higher, and their kind of initial, expectation was that it would kind of be a bit of a repeat of the quote-unquote taper tantrum. So that happened back in 2013. People might not remember it. It seems like ages ago.
It does. It seems like a decade ago, Jacob.
I know. Practically is at this point. But back in 2013, Chairman Bernanke, when he signaled that, the Fed would eventually, start tightening and raising interest rates, that was responded in the market with an uptick in the 10-year Treasury yield, and that led to a massive increase in mortgage rates in a very short span of time, which then prompted a big decrease in home sales. Because it takes a little while for people to adjust to the new norm in terms of rates and whatnot. So this time last year, forecasters were expecting that the beginning of the year would be pretty slow because of the higher rates. But as rates continued to go up and as people kind of adjusted and, stopped, sitting on the sidelines hoping for rates to come back down again, that sales activity would pick up. That's not what happened to some extent. At the beginning of the year, it was slow. The increase in rates towards the end of 2018 did lead to much lower home sales activity in the beginning of 2019. But forecasts to that extent were actually off in the sense that home sales were even slower than was projected. The uptick in rates at the end of last year had a much bigger impact than forecasters realized. So for the first half of the year, sales activity was much slower than was projected. And then for the later half of the year, mortgage rates came back down again. I mean, as you and I have talked about since the summer, mortgage rates fell to a 3-year low back in September. And now we're starting to have these conversations about is there a ceiling on mortgage rates? Is it will mortgage rates ever be able to go back above 5% again? Things like that. So very different scenario. But what's interesting is so then there's been this kind of ongoing question of, well, if rates came back down, shouldn't that trigger sales? And to some extent, sales volume in the fourth quarter has actually been higher than what forecasters were expecting a year ago. So while the first half of the year was worse than expected, the latter half of the year, because of lower mortgage rates, has been somewhat better than was expected this time last year. On the whole, 2019 was not as good of a year for the housing market as people were expecting last year. So what is that? Where does that leave us for next year? What is the expectations for next year? So first off, and this is probably going to put some people at ease, make people feel a little bit better about things. Pretty much every forecaster is expecting mortgage rates to basically stay roughly where they are now. They're not expecting them to go back up. They're not really expecting them to come much lower. And that's because the Federal Reserve has signaled that they are going to, not cut rates and not hike rates for the foreseeable future. They're kind of playing a bit more of a wait-and-see approach with the economy right now. And then if you look globally, there aren't any central banks that are raising rates. If anything, more central banks are lowering rates. So, all that kind of just, leads us to believe that, mortgage rates should not go any higher. They could theoretically go lower if, there isn't a shock to the economy because, the way the Fed responds to that is, by cutting rates. So, if the trade deal negotiations sour or if the election produces an unexpected result or anything, or if impeachment, leads to Trump being removed from office, all those things could lead to mortgage rates coming back down again. So there is a risk to the downside, not really much of a risk to the upside. Then when you look at, home prices, home sales, it's kind of an interesting situation. So one of the big reports that came out this week was the confidence index from the National Association of Home Builders, which showed that optimism in the home building industry is at the highest level it's been at since 1999, which is really, really interesting. And that's for a few reasons, mainly the supply of homes in this country is so low, of existing homes is so low, that's a great, opportunity for home builders. The demand for buying a home is really high still, but people just can't find places that are affordable, or in some parts of the country, it's just almost impossible to find anywhere that's, up for sale. So that's a great opportunity for home builders. Home building activity is going to pick up again. But home building activity won't be, happening at such a pace that it'll, make up for the lack of supply. So, this is the situation that you and I have talked about, extensively. The supply of homes is so tight in this country. So that's not expected to change. And what does that mean? So that means that home prices are going to keep going up. Although they might moderate, in some parts of the country, home prices have just gotten to be so expensive that pretty much no one can afford to buy a home. That's why we've seen companies like, Facebook and Google and whatnot, donating, money to affordable housing funds and stuff because, these, tech companies can't even, their employees can't even afford to live in some of the places where they're based. And so in those parts of the country, and we kind of talked about this last week, on the coast, home prices are probably going to moderate next year, if not come down a bit, because people just can't afford to buy what is available for sale. In the center of the country, though, home prices probably will continue to go up because those areas are becoming in higher demand as people leave the coasts, and also just, the supply of homes in those areas is equally tight. But then, the interesting thing is, when you look at it from, a home sales perspective, there are probably going to be fewer home sales last year than this year, or, if there is growth, it's going to be very, very small.
Mm-hmm.
And that's just because there just aren't homes for people to buy. So this month, or rather last month, the most recent existing home sales data came out yesterday from the National Association of Realtors, and it showed a significant drop in the number of existing home sales that took place in November. And they also showed that the inventory of homes for sale had hit pretty much a record low.
Wow.
So basically what we're seeing is that there are just so few homes for sale that, sales activity is just, slowing to a crawl because there's nothing to buy. It's a very, kind of bizarre situation. And you would think, people would, see this, see how much demand there is, see how prices are rising, and go jump into the market. If you're an existing homeowner, this is probably a good time to sell because, the demand is there, prices are rising, et cetera. The trouble is if you're selling your home and don't have a place
Where do
to
you go? Where do you go?
Where do you go? So, a lot of people are, choosing not to sell for that reason. A lot of people, refinance their mortgages these past few months and now have these rock bottom rates. And, you don't want to necessarily buy a home with a higher mortgage rate. A lot of people are rate locked into their homes. We've got this trend of, the silent generation and baby boomers choosing to age in place rather than move into retirement communities. So, all these trends have led to the low supply of homes, and that's not changing anytime soon. So, the experts I spoke with basically said, there's no way that next year can be a gangbusters year for the housing market because there just isn't the supply of homes there for it to be. Now, taking, kind of a step back, when you look at the broader economy, the interesting thing about this situation is because of the fundamentals being what they are, home construction, the home building industry might actually, kind of help recession-proof the economy a bit. If there is a recession, housing will probably provide an upside for the economy because, even in a recession, people need places to live, and given the low supply of homes there are, home builders will probably continue to be able to do business this time around. Unlike last time, in the last recession, it was caused by housing, and it was caused, in large part by the oversupply of housing. So building activity slowed to pretty much nothing. That's not going to happen this time around. So that is interesting, and might provide some relief for folks, especially if you have a loved one who is working in construction or architecture or anything like that. It's a good time for their line of business, but definitely difficult if you're trying to find a home to buy.
Yeah, I mean, I was, and you were talking about the broader economy, and I was going to ask you what the implications are there for the broader economy, and I think that's really interesting because from what I've read, and you can clarify this. I mean, that is a leading indicator of the economy, what home prices are doing. I mean, outside of the CPI and the other, wages and other things that we typically look at, that the trend for people to buy and sell their homes, because for most people who own a home, right, that's their largest asset. So when they go to
exactly,
and we talked last week about baby boomers and people relocating to these other parts of the country, in the middle of the country, which you said is actually going up in price. But if you can't dispose of your house, you can't sell your house and move into these other regions. How are you going to tap into that for retirement income? I'm just trying to connect all the dots here.
Yeah, I mean, the nice thing about the low mortgage rate environment right now is, home equity loans are cheaper from an interest perspective, although you obviously want to be careful that you're not, putting yourself in a, if you're getting a home equity loan these days, you need to keep in mind, I think the concerns about a recession have kind of petered out a little bit given, the fact that, it seems like the Trump administration is possibly going to close a deal on trade and things like that. So those are the economists I spoke with said there are less concerns about a recession in the next year. But, that's something to keep in mind. If you're nervous about your job or if you're working in an industry that might be, affected by a trade deal, you may not want to get a home equity loan. just because, if you lose your job and then, you've taken out more of your, equity in your home, you can find yourself in a tight situation. For folks who are retiring, I mean, reverse mortgages are an option. I don't want to necessarily recommend them to anyone. You have to study them closely. They are different from, reverse mortgages got a bad rap, ages ago because of, the kind of shady marketing practices associated with a lot of the companies and things like that. But, a lot of that has improved, obviously, but, they're not, a foolproof loan. They are a loan. You don't have to, if you're elderly and you take out a reverse mortgage, you won't necessarily be the one repaying it, but someone has to, whether that comes through, and that might be your loved one, your heirs. And, if you choose to get a reverse mortgage, it can certainly help in terms of paying off, medical expenses, long-term care expenses, things like that. But keep in mind that, any money that you use from the money you've tapped through your reverse mortgage, that is less money that will be left to your children or your loved ones. Now, obviously someone has to pay for those sorts of things, and that might be the best way of doing it. But, I feel like that's a situation, that's a situation a lot of people don't consider is, from like a generational wealth perspective, a reverse mortgage can, leave less for your loved ones in the long run. So, you want to keep that in mind when you are making that purchase, because it can make, if your children are, kind of banking on, whatever they inherit from you helping to fund their retirement, and then they turn around and see, basically the entire proceeds of the sale of, their family home is just going to pay off the reverse mortgage loan, that can make things difficult. So, at the very least, if you're considering getting a reverse mortgage, you should probably talk to your family, your loved ones, whoever, is kind of identified as, being the inherited, whoever's the heir in your will, to make them aware of the loan and, make sure there are no surprises there.
Yeah, really, really smart. 30 seconds, Jacob. You're a personal finance reporter, or you wore a personal finance hat for a long time. Your take on the Secure Act?
My take on the Secure Act, well, I would probably, have to defer to what my colleague, Allie, said about it. She's definitely the one who's been covering it. I think it's good that Congress is acting on this, and I think it was kind of one of many bills in the government spending bill that I found to be potentially beneficial for consumers. Another one was there was a piece of legislation that was rolled into the spending bill that mandated that cable fees, internet and cable fees can't be hidden. Well, that was a big, to me, that's something I've covered extensively. And so, I thought it was good that some of this other, legislation that might not necessarily get passed on its own was rolled into the spending bill and approved in that way. But I think the devil is in the detail with a lot of these things. I don't want to say for certain that, that it, I know proponents of it call it a game changer, and, right now Americans aren't allowed to contribute to an IRA after hitting the age of 70.
Yep.
So taking away that provision is certainly helpful for folks, especially if you're someone who's not, if you're a workaholic who doesn't want to necessarily retire and wants to keep putting money into an IRA, why shouldn't you be allowed to? So, those things are good, but I think, the devil is in the details. And sort of like with the tax bill, a lot of this stuff sounds good on paper, but then what we've seen is that, the tax bill definitely benefited wealthy people in this country, but didn't really benefit the middle class as much as was expected by tax experts. And so, it'll kind of bear itself out. We'll see in the next couple of years, what the effects will be. And, hopefully it does help people save for retirement.
Yeah, absolutely. Well, Jacob, always a pleasure talking with you. Thanks for your insight, both on real estate, which is obviously very important, and also your perspective on personal finance and the Secure Act. Have a great weekend and good holidays, and we will talk to you again next week.
Yeah. Talk to you next week. Take care.
Bye. Yeah. Welcome back. and now we're going to talk about the Secure Act and a whole lot more. Joining me on the line, retirements reporter for MarketWatch, Ms. Alessandra Melito. Hi, Ali. How are you?
Hi, I'm good. How are you?
I'm doing well. A big week this week with the passage of the Secure Act and the signature of the president on the appropriations bill. So let's just jump right in. What can you tell us, and what were you writing about and thinking about this week?
Yeah, so of course I was working on the Secure Act. That was Houston that happened this week. As you know, Congress has passed it. Now it's on the desk for the president to sign. I spoke with a few financial advisors about what they think of this, and some people were ecstatic, saying that this is the biggest piece of retirement legislation to happen in years, and how it was going to get people thinking and encouraged to save more for retirement, and through various provisions for small businesses and just overall, retirement savers who use IRAs and things like that. And then some people were actually saying that, it's great that they have a bill for retirement, but that it's just scratching the surface, and it's not all rainbows. So that was interesting. A few people pointed out that there could be tax consequences because of getting rid of the stretch IRA, which is basically a beneficiary of an IRA had decades, that they could claim the required minimum distributions, which would be very small amounts, depending on the life expectancy. If you were like 25, for example, and you were the beneficiary of an IRA. And now beneficiaries, except for spouses, have 10 years to wipe clean their inheritance from that particular account. So people were saying, well, that can boost your, what you're claiming for taxes, and maybe it could push you in a higher tax bracket, depending on, I guess, how much you make and how much you're getting. With the new rules for the IRA inheritances, you don't have, there's no required minimum distribution within the 10 years, but you have to do it after the 10th year. So it does give a little more freedom, but people said that it could be dangerous for beneficiaries if they don't plan properly for something like that. And then what else? I mean, some people also said that some of these provisions are good, but you won't see any results for a few years, like things that have to do with the small businesses, being able to join or create multi-employer plans that would provide more options for people, because so many people don't have access to a 401k, and this would provide some sort of retirement account for employees of small businesses. But all of that would take a while to implement. It wouldn't just happen overnight or within the first couple of months of 2020. So that could be beneficial for Americans, but it's not something that you will see in the short term. But overall, everybody seems super buzzed to have something that has to do with retirement in Congress. And the fact that they do want to expand retirement security is always a good thing.
Yeah, I mean, we talk about it all the time, right? I mean, this is what we've been hoping for the last 10 years in terms of getting more people into the retirement system. I thought one of the things that you were possibly going to say in terms of reaction was annuities, right? Because we've talked about annuities, and just wondering if any of the advisors, right? You have to, you always have to weigh what people say. I'm sure you, as a journalist, you do this all the time. But from your sources, you have to look at where their bread is buttered. So some people are going to be for it, some people are going to be against it. But I'm wondering what the reaction was, or if there was specific reaction to that in-plan annuity provision.
Oh my gosh, yeah. A lot of the financial advisors that I spoke with were not super excited about that provision. Most people said that that was a major win for the insurance company, and that employees who have access to a 401k plan and their employer that they offer this as an option, they really have to be very careful, because prior to the Secure Act, the responsibility was on the employer. So a lot of companies didn't want to take that kind of fiduciary responsibility. So they were very hesitant to offer annuities, because there are many, annuities can be very complex. even though they do provide guaranteed income and people really, respect that part of the business, there are lots of complexities about like how to incorporate them into your retirement portfolio and all that stuff. So companies kind of steered clear of that. And now that the responsibility or the fiduciary responsibility is no longer on the employer, but rather on the insurance provider to offer the right products to the employer and thereby the employee, there might be more options. Employers might take them up on that. So a lot of the advisors said, there are good things and bad things about annuities, but you have to be very careful. Do your research, talk to an advisor. Don't just throw an annuity in there because now you have that, possibility. You should really look into it more. Yeah. But not a lot of advisors were crazy about it. I mean, some people were, and it's not that annuities weren't allowed in 401ks before this. It's just now it'll be potentially more prevalent. In like that list of products and investment options when you sign up for a 401k.
Yeah, nothing's 100% good and nothing's 100% bad. It's all in how you use it, and you have to do your due diligence as an employer and also as a customer to figure out if it's right for you. Allie, always a pleasure talking with you. Always appreciate your perspective, and I sense that you're excited and you're going to have a great weekend thinking about not only the holidays, but also thinking about how to get more people saving for their financial future.
I will be talking about the Secure Act all Christmas week.
Ho, ho, ho. Allie, always a pleasure. Enjoy your holiday, and we'll talk with you again next week.
All right. Talk to you soon.
Bye.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of our contributors for weighing in this week. They do an amazing job. And I want to thank you, the audience. We couldn't and wouldn't do it without you. Maybe we would, but we certainly enjoy doing it. We love talking about these issues, very important, and we hope that they are informative, it resonates, and we have a little fun along the way. We'll certainly be covering the Secure Act more this week in our programming on BRN AM starting tomorrow, so certainly check it out. And we look forward to talking to you again very soon. So have a great weekend and enjoy your holidays.